wealthresearchgroup.com, and I am very happy to have Lior back on the X22 Report Spotlight. Lior, welcome back to the Spotlight.
Hey, thanks, Dave.
Hey, thanks for being here. Thanks for being back, I should say. I wanted to start off with the Fed and what Powell is saying right now, where we know that the Fed is raising rates, and he's out there saying that he's not going to stop raising rates even if the market is volatile, even if the economy declines, he's still going to raise rates. Do we see anything being affected by the Fed raising rates? Is this going to be a problem for the economy with housing, student loans, anything that has to do with taking out debt? Is this going to be a problem for the economy if Powell continually raise rates?
Sure. So when the Federal Reserve or any central bank, when it tightens monetary policy by raising rates and shrinking its balance sheet, it's creating a forced shortage of liquidity in the markets. So that is always detrimental to various parts of the economy. First of all, it's detrimental to anyone who is in debt, because it just creates a situation where there's less currency to go around. The first entities to be impacted by this are emerging markets, because when they borrow money in external currencies. So as you can see, this is already affecting Turkey big time, but it's affecting other emerging markets as well, because other emerging markets are getting their debt in US dollars. So imagine any foreign country that is emerging, they're using US dollars as a big part of their reserves. So when they are when they are borrowing US dollars and the Fed is tightening that cycle, it means that there's a shortage, but not a real shortage, right? It's like a short-term fake shortage in dollars, because it can be reversed, etc. But it's just created on any tightening cycle. So this is the first problem, and you can already see this happening right now with emerging markets. Secondly, it hurts domestically any corporation which is over leveraged. So in 2009, great time to borrow money, right? Zero rates. The economy is just starting to recover, and you put that money to work, you make good returns. 2010, 2011, 2012. But now you're getting to this point where it's 2016, 2017, 2018, where you borrow money and the economy is already at nearing full capacity. So borrowing money is not a good idea, because earning spreads are going to start shrinking very soon. You're going to see guidance shrinking very soon. And Trump, with slashing with creating tax cuts, basically he kicked the can down the road another year and a half. And so these borrowers had more time to rectify, the CEOs had more time to rectify the situation. But overall, we're seeing a situation right now where interest rates, as they continue to rise, they create a new balance between how much risk you want to take as an investor in the stock market compared to how much risk-free yield you get when you invest in 10-year treasuries. To give you an example, in the next 10 years, it's forecasted that the S&P 500 will return about 5% per year, because it had very good returns for the previous 10 years. Then obviously appreciation in the next 10 years will not be as massive. So when you can lend the U.S. government money for 10 years at a 3.2% return right now annually on the 10-year bond, or you can make 5%, perceived 5% in the forecasted 5% in the stock market, taking more risk, there's more money that's going to start shifting from stocks to bonds. Now, as you raise rates further, you just tilt that balance even more. So everything is judged off of the 10-year bond. All the risk in the world is judged from that bond. When the rates are zero, obviously stocks are much more attractive. But when the rates are 3.2% and they're going to rise to about 4%, 4.5%, then obviously if you can lend the government money at 4.5%, or risk your money in the stock market for 5%, that's going to tilt the odds. Now, what's going to be very interesting, Dave, is what's going to happen if the 10-year bond yields about 3.5% to 4%. The stock market is forecasted to yield 5%, and there's about 4 to 5% inflation. If that happens, neither bonds nor stocks are attractive. And in that situation, investors look for deep value in undervalued commodities. And therefore, it starts a commodity super cycle. Now, we're not there yet, and we may not get there. So bonds or stocks can remain very attractive compared with each other, and therefore you can have a situation where commodities don't enjoy a bull market. But if inflation starts to go higher, then you will see a situation where there's going to be a huge shift in how investors see risk and how they see reward, and they're not going to take neither the 4% yield on fixed income when there's a 4% inflation, because basically you're lending money to the government for free, and you're not going to take the risk of buying stocks for 5% when 4% is inflation. So that is sort of where everything's going on. That is why tightening or raising interest rates is such a delicate balance, which is never done right. Throughout the Fed's tightening cycles, 13 tightening cycles in all, we've had recessions now in 12 of them, and this is the only one we still haven't seen a recession in the stock market peak, but it is coming. In other words, you should expect the bull market to end at some point during this, where people, investors as a whole, just say, okay, this is it for me. And then obviously there's an event, there's an Enron event, there's another, it doesn't matter. There's one event that changes the perception. There's a Lehman moment, what we call now a Lehman moment, right? Now, why is Jerome Powell talking about raising rates no matter what the economy is doing, no matter how volatile this would happen, etc.? Why is he signaling to the market this? He wants to tell the market two things. One, there is no daddy anymore behind you. So don't expect market intervention from us. From now on, the risk is increased. Whereas from 2009, we were at your back. Anytime there was a slowdown, we came in, we helped, we monetized, we intervened. Now that's it. We can't afford to do that anymore, because politically and in terms of perception, the Fed cannot intervene anymore in the markets. Right now, it's politically very unpopular for it to do so, with the banks being very healthy overall, and with Donald Trump and the administration taking a lot of credit for what's going on in the economy. So for the Fed, this is the perfect time to say, hey, we have done what we needed to do for the past 10 years. Here's the result. And now we're kind of exiting. We're shrinking, we're marginalizing our monetary policy. From now on, it's going to be fiscal policy, or the government, that will have to carry the economy forward. And I can talk about what I think the administration will do going forward in terms of fiscal policy. But Dave, the big key here is that monetary policy is not effective anymore, or it will be less and less effective. You're not going to see them slashing rates because it's not going to help. You're not going to see them doing QE because it's not going to help. And they know this, and therefore what they're telling you is, hey, we are exiting our position as market intervener. From here on, you're on your own, investment community, and whatever you think is the most efficient thing for your portfolio, do it, because we're not going to save you from volatility going forward. So this is the first thing that they're telling you. They're telling you, hey, monetary policy is not going to be big in the next 10 years. We're marginalizing ourselves. We're shrinking our position into trying to make sure that you don't even know we're there. So that's one thing they're doing. The second thing they're doing with telling you that they're going to keep raising rates is what they're telling you, what they're signaling to the market is, make sure that you understand that we're in a situation where our interest rates in the United States must rise because we fear inflation. Now, they won't tell you that, because that obviously will create a panic, but that's essentially what they're telling you. We have a very strong relative economy in relative terms to what it was 9 years ago or 10 years ago. And therefore, there is the risk that with tax cuts and with wages increasing right now, Dave, especially for Americans who are full-time workers, because they're asked now by employers to do extra hours or overtime, right? And there's a shortage in skilled labor. So there's a fight for good employees among employers. So they're raising wages. Now, raising wages is the number one telltale sign of inflation, more than anything else. So what you're saying, what the Fed is signaling you is, hey, inflation is now becoming an issue, and we see it, and therefore our problems are not to try and make sure that the markets stay up. Our problems is to make sure that inflation doesn't go out of hand in the U.S. So I hope that answers your question. The big transition here is from monetary policy to fiscal policy, and the other big transition is, hey, the Fed is not worried about deflation anymore. It's worried about inflation. And I'll tell you, if you want to, I'll tell you why they're worried about inflation, and it's not only the wage increase that worries them.
Well, what's the reason they're worried about inflation then?
Well, okay, so going back to what I said before, some countries have to borrow in foreign currency in order to grow their economy. The U.S. does not. The U.S. can issue more bonds, and it can issue more bonds because the rest of the world is sort of forced to come to the auctions and buy. Now, we have seen the Federal Reserve do this thus far, accommodating the deficit spending for the U.S. economy, but the Treasury has now seen for about 2-3 years where the Federal Reserve is not only shrinking its balance sheet in terms of mortgage-backed securities and Treasury bonds, but it's letting it roll off. In other words, when it's maturing, the Treasury has to buy back the bond, and that's it. The money's destroyed from the system. So when you have that sort of a situation, somebody else has to come to the auctions, foreigners. Japan and China have not been net buyers for about 10 years now. So when you have the three largest bond buyers, the Federal Reserve, China, and Japan, along with Russia, not increasing their bond purchases, but still the United States is running about $1 trillion worth of deficits, it means that going forward in the next 2-3 years, whether it be Trump or a new president after the election cycle, he or she, whatever it is, right, they will have to decide how they monetize this debt. And they might run into a situation where foreign governments are not willing to lend the U.S. government money anymore in the way that they have thus far. And this is because the new policies from the administration are distancing the globalist agenda. So obviously, up until now, all these foreign governments were very willing to buy the debt because they received foreign aid and they got a lot of favors in other ways. Trump is having none of that. He's trying to renegotiate trade. He's not even trying. He's renegotiating trade. He's renegotiating many agreements that other countries were relying on for decades now. And so the willingness of other countries to keep lending the United States government trillions of dollars so they can run massive deficit spending and pay their own citizens in massive entitlement payments, because that's the biggest expenditures on the budgets. Social Security, Medicare, Medicaid, interest payments, and income security are the four largest expenditures. Then you have defense and education next. So when you have that sort of a situation, that creates a problem where the U.S. might need to actually print money, not issue bonds and have the Fed monetize them, but actually print currency, which is the next phase. And that sort of a situation, you have internal inflation. When you create your own currency, denominated in your own national currency, that creates inflation. And the U.S. hasn't had to do ever. It always issued bonds and had somebody buy the bonds. So the debt was always outside of the U.S. banking system. 50% of the world's dollars are not within U.S. soil. Just imagine that. What other country has 50% of its currency circling around 200 other countries? None. And so when you have a situation where other countries are saying, hey, we want to send back some dollars, and this becomes a problem, you have inflation. And therefore, the Fed is trying to do whatever it can to offset some of the policies that President Trump is taking. Now, these policies are not bad. Trump is only reacting to a new world, because this is a new world. There's a rising power in China, and there's other options for investors. So foreign governments will prefer to lend the Chinese government money going forward in a few years than they would rather to do it with the U.S. So there is a rising power, and there is an empire in decline here. And this is a big, big, big situation that doesn't happen very often. The last time we saw that was in the 1930s, right? So, and you remember what happened in the end of that decade. So we have a big problem on our hands, and major changes are happening, and therefore the Fed is kind of taking a step back, and it wants to see what the government will do in terms of how to handle the deficit spending and how to handle entitlements, which are going to be the focal point of the next election cycle, and how this all pertains to the reserve currency role of the dollar, which I don't think is in immediate jeopardy because there's just no other alternative right now. But it is in a situation, like you say, where other options will start to be discussed in the next decade. So big changes. That's the bottom line here.
So, I mean, from what you're saying, it sounds like countries are going to start losing faith in the dollar, and they're not going to be purchasing, bonds, and we're going to have to create currency, which causes inflation. How does gold, is gold affected when inflation hits here? Because right now gold is right below $1,200 per ounce right now. We know there's a lot of manipulation, a lot of paper contracts are thrown at gold. Is gold going to break out when inflation hits?
Okay, so the ideal scenario for gold is that, like I said before, both bonds and stocks are at par with each other. So they're both forecasted to yield about 4%, 5% a year, but inflation is also 4 to 5%. So in other words, there is no reason for an investor to either own a bond or to risk in the stock market. And therefore, investors will look to deep value. They will look at what asset class is very historically cheap compared to what it is, compared to averages. And they will look at commodities. Within the commodities space, obviously gold and silver are very attractive. Not yet. Okay, so this is not a back up the truck moment at any. It's just not the right time right now. But will it be the right time if these conditions are met? It will be the mother lode opportunity. But it's just not right now. So don't bank on one scenario, on one possible future scenario, because it might not happen. But if it does happen, then yes, gold will be very, very attractive, because one, there's inflation. Two, there's going to be a very weak dollar. The dollar can, Dave, you can quote me on this. The dollar can go down about 25 to 30% if there's printing of currency in the U.S. to fund the deficit. 20 to 30%. So if the index is about 96 right now, the DXY, it can go all the way down to 70, which is its all-time low. And this can happen very fast in a matter of 4 to 5 years. So that's huge. And obviously that is huge for gold and for commodities as well. So in that scenario, yeah, that's just incredible for precious metals, for industrial metals, for agricultural commodities, etc. Just make sure you understand where I'm coming from. This is not reality right now. For right now, the way the world is, stocks remain the most attractive asset class. Though they are trading at all-time highs, the alternatives are not that great. In other words, stock can remain elevated, expensive, and become even more expensive as we go forward, because the tax cuts have created record profits, and disposable income in the U.S. is going up with the tax cuts. And so the spending economy is going to work for another 6 to 12 months. And so it's just regular market cycles. It's going to be a euphoric peak, and it's probably going to take another 6 to 12 to 18 months until we see the stock market really top out.
So what you're saying is that Trump put forth these tax cuts to buy him some time. I mean, I guess he realized that the economy would not be able to make it, and he had to do something. So putting these tax cuts into place, it bought him, what, another 2 years or so? Or 3 years?
I would say about 1.5 to 2 years.
I mean, I guess that's why we're getting the warnings from like the IMF where they're saying, the second Great Depression is upon us. And those, central banks that are raising rates, they're the ones who are causing this problem. And they're out there. I mean, Christine Lagarde is warning us like crazy that we have major, major problems in the global economy. Is this why they're warning the entire world that something bad is about to happen?
The biggest problem is the wealth gap in the United States. So if you go back to 2008, Dave, and you think about what the policymakers, what the Treasury Department, the New York Fed, and the Federal Reserve Board of Governors decided to do, they favored the financial system over the homeowner. And therefore, they bailed out financial institutions, the financial sector. And in doing so, they signaled to the market that the real estate market will rebound and that the stock market will boom. But all of this came at the expense of mainstream America, of the average person. And therefore, you see a situation where in 2011, most millionaires have already recovered to pre-crisis net worth. So for them, the recovery was already done by 2011. They've experienced a boom since 2011. For the upper middle class, those who work for the giant tech companies or for the multinationals, from about 2012, 2013, their wages have started going up. They've seen opportunities to go up to excel in their career. And so for them, the recovery has already happened as well. For the majority of the middle class, the recovery it started around the time that Trump got elected. And for a large section of the population, the lower middle class and the lower income, there hasn't been a recovery at all. They haven't seen any growth in wages, any growth in savings, and they have no assets. And we're talking about between 100 to 150 million Americans, so about half the country, that has no assets, very little savings, and no job, no growth prospects in their jobs, in their career paths. And so this is the wealth division that is going to dictate the next recession and how it's going to look like. If I can give you an analogy of this, here's something to think about. Think about a father that dies, and in his will, he gives to his 3 children a house. The house is in an all other state than where these 3 brothers are living. Now, these 3 brothers they don't talk with each other. They hate each other. They're not a good family. The house itself has some, a few $1,000s worth of back taxes, some overgrown bush, etc. But with a little love, it can be rented out easily. It's in a great place. Another father is also died. Now he left his 3 children 12 homes. They're all running down homes. It's going to take a gut job. You need to go all the way to the foundations to take care of this house, of these houses. And they're all scattered. They're scattered throughout the U.S. Very, very tough job to do. But the 3 brothers are very, very close with each other. They have a bond, and they like each other. The family with the brothers that hate each other, it takes them about 1 month to just pick up the phone and talk with each other and think about what to do. Another 2 months to get their act together, and 3 months to get this house rented out again. So all in all, it takes them about 6 months to handle one house. The other three brothers, the day after, they already have a plan, and about a month later, all the houses are rented. The point of this story is that even a small problem can become an elephant to a country that is divided, to Democrats and Republicans that can't stand each other, to a central bank and a banking system that don't want to be perceived again as colluding with each other. This is going to be a big theme, Dave, in the next recession. The banking system, so JP Morgan, Wells, Bank of America, all the investment banks, Goldman, they'll want to distance themselves from the Federal Reserve so that they don't get into a problem where they're, again, the most hated community in the United States. So you're going to have big problems, even if the real reality, the problem that is at hand is small. Because when you have division, even a small problem becomes a huge, huge hassle. Whereas a very united country can handle lots of problems. So this is the major issue. This is why the IMF and the BIS are issuing these warnings, because they know that politically it's going to take a miracle to make sure that the United States doesn't fall into the trap of making a short recession longer, a quick sell-off in the market into a panic sell-off, and and doesn't create a situation where there's a world panic again. So this is where we are right now. Now, I just want to make sure that I let you know, Dave, that for your listeners, because I know that they're very sophisticated, I created a special report which is called wealthresearchgroup.com/bear, like bear market, and it has my 11 best strategies for the gold bear market, exactly how to act and position and get involved right now inside of the bear market to control yourself and position, prepare, anticipate for when the time comes to go into bull market mode. So that's one thing I want to make sure that people know, that they can access this PDF file that is comprised of 11 strategies that I've worked out over the past 7 years of this bear market, and that is going to be very, very good for aggressive traders.
Now, Lior, I just want to ask you this question because you mentioned that the banks, JP Morgan, Goldman Sachs, Citibank, and the rest are going to distance themselves from the Federal Reserve. Why? I just want to clear this up. Why do the banks have to distance themselves from the Federal Reserve? What's going to happen here?
Go back to 2008. When for example, when JP Morgan or Jamie Dimon got the call from Hank Paulson and told him, hey, you need to come to Washington. We are in an emergency, and all the banks are going to take TARP money. Now, imagine you, Dave. Imagine you going to your banker. Your banker tells you, hey, I need to inject some funds into your account. You're in bad shape. And you tell him, no, I'm not. I'm not in bad shape. And he tells you, yeah, you are. So how would shareholders of this company feel about your financial status if you go home and tell your wife, hey, the bank called, it's going to inject capital into our account because it says we're in dire shape? How would your wife react? She'll want to know why, right? Why are we in dire shape? She'll panic. The same thing happened with TARP. Many of the banks were not in a situation where they had liquidity problems that they had to take the TARP. But the Treasury made it so that every bank has to take it because it didn't want to reveal which banks are weaker than the rest. And so all the banks got TARP money. All the banks issued then record bonuses to their CEOs, which made them very, very hated until today. And so they wouldn't want to do that again because it killed their mortgage business. People were afraid to take mortgages. People didn't like banks. That cratered shareholder value. And it created a situation where America's banks are now very, very, very hated in the economy. And they wouldn't want to do that again. Remember, these are public companies. People like you and I can buy shares of JPM, and we're the owners tomorrow. So the CEO has to address the board has to address the shareholder base, etc. They will want to distance themselves from the Federal Reserve as much as the Federal Reserve will want to distance himself from the government. All of the focus will be on the president and what he will do. Will he go after entitlements and tell the population, hey, we have to start thinking about our entitlements. We have too many of them. And either we're going to postpone the age of recipients, or you're going to have to continue working and show pay stub in order to get a Social Security, or we're going to change the terms. There will be a pushback. There will be a revolt. There will be some unrest in the U.S. as they start doing this because the party's over. In about 5 to 7 years, China's GDP will be number one. They will have a bigger economy. Other nations will want to work with them more than they'll want to work with the U.S. And you will see a rising star, basically in the global economy, a new empire. And this friction is just very, very hard to politically and diplomatically handle without creating any conflicts and without creating any problems. So this is a big problem.
Do you think at this time, I mean, Ron Paul was out there saying that the market might come down by 50%. I mean, if this does happen and the market comes down by 50%, people are going to panic. People are going to, say what's going on here. Most likely the housing market then would come down in the U.S. Would this start a domino effect around the world? I mean, you already talked about the emerging markets, how they're getting hit with the interest rates moving up. If the market comes down and the housing market crashes and everything starts to happen here, what happens to the rest of the globe?
I think it's important to understand that there's a dividing wall between the problems that the federal government has and the problems that the private sector has. The private sector in America is not indebted. By that I mean that corporations are not indebted. There's a huge problem with student loans, which are insured by the government. There's record high credit card debt and household debt. But in terms of servicing that debt, it's not a problem. So we aren't leveraged in a situation where the private sector is in jeopardy of defaulting on a lot of credit card debt or on a lot of household debt, mortgage debt, etc. Corporations are not in a huge risk of defaulting on their bonds. The only entity that is in real problem is the federal government with 21.5 trillion worth of federal debt, with about half the country on receiving some sort of benefits, entitlements, whether it be food stamps, veterans, Social Security, Medicare, Medicaid, etc., income security, child benefits. There's a lot of them, right? So this is the major problem, and therefore it's important to understand that there's a difference between what the stock market will do and what the housing market will do, compared to what the problems of the federal government is. So with the stock market, yes, it's expensive, but it's not a distressed market. In other words, for it to fall 50%, there will need to be some sort of a huge problem that trickles from the government and onto corporations or the private sector. Otherwise, there's a shortage of housing right now because millennials are starting to move out of their parents' homes, and they actually need homes. So the real estate market is not in a situation where it's going to come back down 50%. It's nothing is impossible, right? But you're asking me about probabilities. The probability is not high. I know many people, love to say, "Hey, we're about to it's everything is manipulated, everything is rigged about the world. It's all a big sea of debt." It's true that there is much debt, but the problem is not debt. The problem is always servicing the debt, and that is what's called that is what caused 2008. Debt was not the problem. Servicing the debt was the problem. And so, if you have a problem of servicing the debt, that is or paying the interest is what I'm saying. That is a huge problem. In the private sector in the United States, this is not a problem right now. This is not a big problem right now. So, in terms of the stock market, I would say there's a bigger probability of it going up from here about 40 to 50% than it going down 50% at this particular time. Now, after it tops, I do expect it to fall between 20 and 30%. For it to fall 50%, there would need to be simply panic, a big panic. And if there is panic, then yeah, why not, David? It happens, right? Let me give you an example. If you had known for every 10-year forward, so if I whispered in your ear which 10 companies would be the best performing companies in the world from 2018 to 2028, and you held on to them, and then you do the same from 2028 to 2038, you would have the best portfolio in the world. The 10 best performing stocks, you would own them, and only them. Even if you had known this, backtesting this strategy to 1913, there will be six times where your portfolio would be down 50% or more. In other words, there is no way to avoid risk when investing. But if you panic sell, then you will always lose. The only reason to sell an investment is the risk of permanent loss. If I may just explain this for 1 second. If you have an investment, a property, a house, and there's a renter in there, and there's a big panic around the country, and people are selling their homes for very discounted prices, does it mean that you need to sell your particular home as well because you bought it for more than it's worth right now? The answer is absolutely not. Why would you do that? There's a renter in there, you're getting positive cash flow, and the price of the home doesn't matter at this point. You're not a distressed seller. Your home is not burned down. It doesn't have foundational issues. Nothing happened to it. Your neighbors decided to do something irrational. Why would you join them? And the same thing goes on in the stock market. Why would people, and I am the best example of this, Dave. In September 14th of 2008, I took a boat, a kayak, and I rafted for 4 days with no phone signal in the Colorado River. In September 18th, so 4 days later, don't quote me on the dates, it could be September 14th to 18th or September 17th to the 21st, but for a 4-day period, I was without signal. And when I came back to civilization, the market was already experiencing the meltdown, right? And I'm looking at myself saying, what happened in the 4 days that I was rafting to make a company like Intel worth half as much as it did 4 days prior? Did the entire chip industry change that I'm not aware of? In other words, I was not part of the panic, so I had a unique perspective on this entire situation, and I was going company by company, asking myself, is this company selling at a huge discount because there's a permanent problem? It's lost its competitive advantage. Its peers are outperforming it. Its CEO is doing bad choices, or is this just forced liquidation, market investors getting margin calls, and just massive panic? And those questions helped me to hold on to my portfolio and even double down on some stocks. And so that's what I ask the listeners to also think about, whether or not the portfolio holdings that they have are these solid companies, are these companies with a fortress balance sheet, companies that have a very good loyal branding power, and companies that are in growth mode, and their financial situation is not an issue. And when the market sell-off happens, think about whether or not you want to sell those stocks or you want to hold on to them and perhaps even increase your position in them. Because if you look at the stock market on a 100-year timeline, you can see that the stock market is one of the best ways to make money over time. Are there sell-offs? Yes. Are there panics? Yes. But is this a problem where there's a permanent loss risk, which is the only risk, right? Where you permanently lose some of your money? And the answer is no. All of the portfolio holdings that I had in 2008 were great companies, and therefore their price is about double to triple to quadruple to even some of them are up 500 and 600% since 2008. And imagine what happened if I would have sold them. I wouldn't have participated in this comeback. Now you may say, hey, the comeback is induced by the Federal Reserve or the banks, etc. That's true. It might have been a weaker recovery in the stock market or more prolonged. But the companies themselves are very good companies, and therefore investors will always choose to own them on top of other less stellar investments. So think about that as well, and understand that you need to kind of divide the problems into private sector and government. And I would say your biggest problem is government, and that problem goes into your main career and not to your investment career. I think the stock market will continue to do very well over time, and the real estate market will continue to do very well over time. What I think will not do very well is, or as well as it's doing right now, if we can call it success, is the jobs market, because the U.S. is losing its competitive advantage in the world to cheaper labor countries, to automation, to robotics, to technology and software. And I think that the generations, both the millennials and the baby boomers, need to really start to think how they create value in this global world, unless they want to get stuck with the same wages for 30 to 40 years where you don't beat inflation, right? That is the problem, right? Not beating inflation. You understand? So if your investments are rising better than inflation, you're getting wealthier. If your wages are not beating inflation, then you're stuck in place. So that is the main issue to consider here.
Lior, thank you very much for being on the X22 Report Spotlight. Once again, how can people see all your work?
So best thing is to follow the newsletter where I publish our top rank, most important ideas. And we also publish, actual portfolio holdings, trades that I'm personally doing. Every 2 month period, I release a full scope of what happened in the last 2 months in my portfolio. And when we have time-sensitive opportunities, we also publish those. I don't know if you know this, but earlier in the month of September, on September 5th, we published a report about a beverage company that had released very, very favorable news. In 2 weeks, the company soared 525%. And so that was a major, major win for subscribers. And we are now looking at two new companies that we're going to profile next week and the week after, in light of the fact that the Canadian government is going to officially legalize cannabis in Canada, which is going to open the motherlode opportunity in the U.S. as well. So I created two special reports on two companies if you want to check that out. One is wealthresearchgroup.com/CAN. So that's CAN. And the other one is wealthresearchgroup.com/world. And this is a company that I'm very excited about because it has an international appeal to the cannabis sector. It's not only North America, but it's making its moves around the world where cannabis is right now one of the fastest growing industry, but it's in infancy. And one other thing that I want to make sure that people know about is we released our most extensive and in-depth full-length documentary on our YouTube channel. It's called America Radicalized, Empire in Decline. It's a 37-minute video, and it is going through basically everything we just talked about, but it very in-depth and with graphics and charts, so very detailed information, Dave.
Lior, thank you very much. Send me all those links and I'll put them at the bottom of the video to make it easier. They can just click on it and go right over to what you've been talking about. Once again, thank you very much for being on the Spotlight. I really appreciate it.
Dave, thank you for the opportunity. And people really need to make sure that right now they understand that financial education, staying updated on what's going on and listening to the right people and not to emotional people and panic people, that is the best way going forward.
Yes. Thank you once again, Lior. Thank you very much.
Thank you, sir.